Have you worked in the UK and accumulated assets within a UK pension plan? Well, if the answer is yes, I have some good news. You may be eligible to transfer those funds tax-free to Canada into what is known as a QROPS, a qualified, recognized overseas pension scheme. This is an account registered in Canada for the purpose of receiving certain UK pension assets. They're available through only a handful of eligible Canadian financial institutions that are approved by the UK tax authority. Currently, there are only 4 such approved Canadian companies. And scheme, that's the British word for what we call pension here in Canada. A QROPS is a retirement account specifically designed for people who are at least age 55 or older, who have been Canadian resident for at least 5 years, and who plan on retiring in Canada. They would also want to have what was their UK pension now invested and denominated in Canadian dollars going forward. A QROPS looks and feels very much like a conventional RSP with similar rules. Like a regular RSP, your QROPS investments benefit from tax-deferred growth between the time of your transfer to the time you need to start drawing an income off those assets in retirement. Once inside a QROPS, the dollars are yours. You have the flexibility to own a wide range of investments, including bond funds, guaranteed funds, dividend, equity funds, Canadian and global funds, balanced funds, and even specialty funds, including infrastructure and real estate assets. The list is quite comprehensive. And also, like an RSP, any growth or income generated in the account is tax sheltered. You may also switch and rebalance your investments as appropriate, all without triggering any tax payable. The transfer from UK to Canada is tax-free, and you don't need to have any available RSP contribution room to do this. You don't need to file a tax return with the UK either. Everything is handled in Canada with your investment team here and the CRA going forward. When you need to start drawing an income, we would simply convert your QROPS to a RIF under the same rules that would apply for your RSP. The QROPS investments will roll tax-free from the QROPS to the new RIF, and then you may start drawing a retirement income. You must convert your QROPS to a RIF no later than the end of the year in which you turn 71. Again, the same rules as an RSP, but then you must begin to start drawing an income from the new RIF the following year on a certain schedule known as your RIF withdrawal factor. This table lays out the minimum RIF factors, which are percentage withdrawal requirements based on your age. This percentage is applicable to the value of your RIF on January 1 the following year, which is in fact the year you turn 72. And this table lays out the minimums, but you can take out more subject to tax because all RIF income that is withdrawn is taxable. You can see each year as you get older, the government is requiring you to take out more and more on a percentage basis in order to take that money from a tax sheltered account into T4 taxable income. The government wants their tax money. You can convert your QROPS anytime prior to age 71, though. Like if you need the income earlier, say you decide to retire earlier, but if you don't need the income, allow those funds to grow inside your QROPS tax sheltered for as long as you can. Now let's look at a quick example. Say you turned 71. You must convert your QROPS to a RIF by the end of this calendar year. All assets will roll from the QROPS to the new RIF. Say now on January 1, your new RIF is valued at $500,000. You would multiply this by your RIF factor based on your age, in this case, 5.28%. And doing that math is $26,400. And this is the amount that is the minimum you must withdraw as income from your RIF. Often people will take this in monthly payments to match their lifestyle spending needs. Private sector defined contribution plans, private sector defined benefit plans, and fully funded public sector defined benefit plans can be transferred, whereas UK government pensions cannot. Defined benefit plans over £30,000 require the review and sign off of a UK financial advisor before a transfer can be made. We've established relationships with reputable and capable partners for this aspect. Oh, and defined benefit plans under £30,000, they don't need this special sign off, nor do defined contribution plans. But again, The UK will only allow a transfer to only one of 4 eligible Canadian QROPS providers. Will this affect my RSP contribution room, you might ask? Well, the answer is no. Transferring your UK pension to a Canadian QROPS will not affect your RSP contribution room. In fact, you do not even need to have any available RSP contribution room in order to effect this transfer of your UK pension. The net effect of this process is a tax-free transfer to Canada. Funds are converted from pounds sterling to Canadian dollars, then invested in a Canadian QROPS where they grow tax sheltered, all like a conventional RSP, until which time you decide to draw an income in Canadian dollars, and then tax is payable on the income drawn to the CRA. Now, as I just mentioned, tax is paid on any money withdrawn from the QROPS or the eventual RIF. This is taxed as regular T4 income, just like regular salary, RIF, or pension income. You can name a beneficiary of your QROPS. If you name your spouse, there is a 100% tax-free spousal rollover upon your passing to an RSP or RIF in your surviving spouse's name. You could name your kids as beneficiaries as well, but in this case, there would be tax payable before it moves into their hands because the spousal rollover provision wouldn't apply. You may consider the benefit of naming contingent or secondary beneficiaries as well. You can always change and update your beneficiaries as you see fit. The net effect here is that the money can have a lasting legacy effect because it will pass to your loved ones according to your wishes. You make only one cost-effective currency exchange transaction at the outset when you move the money from the UK to Canada in the first place. All income drawn would then be in Canadian dollars, reducing exchange rate costs and headaches with future currency fluctuations. And this whole process can actually take up to 3 or 6 months to complete. Rules can change as they did about 10 years ago. So if you're considering this option, you may want to look at this closely before any other rules change or if this availability window closes entirely. Thanks for visiting UKCanadaPensionTransfer.ca and cheerio.